Hi traders, welcome to my channel. I am OT Josh. In this video we'll be talking about trading with the Bollinger Bands, how to set the Bollinger Band and the uses of the Bollinger Band indicator. Okay, so what are Bollinger Bands indicator? These indicators are volatility indicators. In other words, these indicators they help track the movement of price when price has gone beyond its normal movement. By that I mean they help us identify when price is oversold in a downtrend and when price is overbought in an uptrend. So before we go on, let's check, or let's see how we can set up these indicators using the platform IQ Options platform. So like I said, volatility indicator, that's the Bollinger Band, is under the volatility. So if you come here, you see the volatility indicators. These are all volatility indicators, but the best in my opinion is the Bollinger Band. So you're going to come here, the period is 14 and the deviation 2. The colors are default, so if you apply, yes, this is what the Bollinger Band looks like. So this is the Bollinger Band. We have the upper band, the middle band, and the lower band. The upper band is the 2 deviation. That means that is 2 deviation away from the middle band, and the lower band is 2 deviation away from the middle band. So the upper band is used in an uptrend when the price is overbought. When the price is going up and it's overbought, you'll find out that the price has gone outside of the upper Bollinger Band. At this point, we can say that price is overbought. And when it goes down as well, like here, you can say price is oversold because the price has come down outside the lower Bollinger Band. The same thing happens here. It has come down outside the lower Bollinger Band, so price is oversold. And then when the price is oversold, all you have to do is to look for trading opportunities for price to go back inside. Naturally, when price is overbought or when price is oversold, the market tends to come back inside the band and goes back to the middle. This process is called the mean reversion. The mean reversion is the process whereby an overbought or an oversold price tends to go back inside the band and goes to test the middle Bollinger Band. So for instance, after this price went up here outside the bar, it reversed to this middle Bollinger Band. It may not be touching it because in trading nothing is 100% accurate, but this is the idea that it goes back. And when it came back here, you can see this wick here, it came back, went outside, and then goes back again. So this is what the Bollinger Band is, and this is the setting. Basically, the Bollinger Band is used to track overbought and oversold condition. And for you to track overbought and oversold condition very well, you have to have a certain market condition, which mostly is the ranging market. So for instance, the range, this is a market whereby the market started ranging from here. As you can see, the market started ranging from here. Okay, this is the range of the market just here. So this is the range. This is where the market started ranging from. So you can see that the market is moving up from here. It went up from here, made a high, came back, up again, it came back, up again, it came back. Now it will go up and it will come back again. Now if you look at this inside this box, what you will find is that at this point the market has started reacting with the middle Bollinger Band because it's at the lowest point of the downtrend, and at this point the market is reacting with the upper Bollinger Band because this is the highest point of the uptrend relative to this box, not here, not here, relative only to this range. Now as you can see, this range is on its own. It has nothing to do with this other part of the market. This is a trend line. So for this trend line, you can see that here is the oversold and oversold. Now this trend line, this market condition is over. We now have a new market condition in this ranging market. So this is how the market is working now. And there are some times we can see the trend line is long and from here we had also the same thing. We had ranging markets where price was moving up and down, and then it moved, the market condition changed to a trending market. So now this is what we have for the Bollinger Band. We've seen how the Bollinger Band goes to an overbought and an oversold condition. So next, let's look at how this Bollinger Band can be used with other technical indicators such as the stochastic and the RSI for confirmation of what we have seen. So for stochastic, you can come here and you can put the stochastic oscillator. Now, one thing about why I'm showing you this is for us to confirm what we've just seen in our Bollinger Band. Now, I told you that the Bollinger Band, we use it to measure overbought and oversold areas. The same thing is there with the stochastic oscillator or the RSI as well. So if you look at this, you can find out that this was an oversold condition, and you can see the stochastic oscillator was in an oversold area. If you look at this point here, the oversold, it was also in an oversold area. If you look at this point here, which is the overbought here, you should look at it, it was also in an overbought area. So this can be used, the same thing here, but it wasn't going, it was out. If you're going to draw a support, a resistance line here, you'll find out that this is also an overbought area, and everything is showing here in the chart. If you look at the left here, you can see the same thing is happening here. So with this, you can use this as a confirmation to confirm that the price is in an overbought area. The RSI is the same thing. You can use this to confirm it too. Now, we've talked about Bollinger Band for the ranging market. What about in a trending market like this? We cannot really use the Bollinger Band like this, so we are going to use the double Bollinger Band. So to set your double Bollinger Band, all you have to do is to come here, go back to the Bollinger Band indicator. Okay, this is the Bollinger Band indicator. I'll delete it now so that I can set it all over again. So the settings are like this. You go back to your Bollinger Band. This is the 14 deviation 2. Now I'll come to the color settings, and I'll put this as green for the upper line. I'll put this as white for the middle line, and I'll set this as green again for the upper line, and I'll use apply. So we have this. This is the same thing as our first band. Yes, it is the same thing, but to get the double Bollinger Band, you come back there again, and then you use the Bollinger Band settings. At this you use the period 14. Deviation should be 1. Sorry, the deviation should be 1, and then you come to your color. I'm going to use white. I'm going to use white, and I'm going to use white. Okay, so I'm going to apply it now, and this is what we have here. We have the two deviation, but we have the 1 deviation now, and the 1 deviation, and then we have the middle Bollinger Band. Now I'm going to show you why this 1 deviation is appearing and the use of this 1 deviation. Now this, like I said, in a ranging market you really don't need this, but look, in a trending market, what you'll find out is that the Bollinger Band, with the price will stay in between the 2 deviation and the 1 deviation lower. If you look at this price, the market is always inside this band here, not going outside in a strong market. So therefore, with this, you can see that the market is overall going in a downward direction. You should not be doing your call trade. You should be waiting for the market to get to the edge of the band, where you find an opportunity to do your put trades. The same thing happens in an uptrend market. Let me find an uptrend market here, a strong uptrend for that matter. So we have something here like this. You'll find out that the market in a strong uptrend will move in between the 1 deviation upper and the 2 deviation upper. 1 deviation upper, just like this. The market is not going to leave, but immediately it leaves the 1 deviation upper. What happens? We saw that the market is starting to change its course to a downtrend. So this is how we use the Bollinger band indicator. The information that it gives, like in this case, the information it's giving now is that price is in a ranging market here. Price is in a ranging market here. We know price is in a ranging market here. Let me show you. This is a ranging market. Now, what the information this Bollinger Band is telling us is that if price should come outside of this band, then it's what? An overbought position. And with this overbought position, we can take advantage of it by selling. So in general, we can now understand that prices are high at the 2 deviation Bollinger Band. As you can see, it's coming back down, and prices are low at the 2 deviation lower Bollinger Band. I'm going to repeat this. Price are high at the 2 deviation upper Bollinger Band in the ranging market, and price are low at the 2 deviation lower Bollinger Band in the ranging market. So if prices are high in the 2 deviation upper Bollinger Band in the ranging market, and you have that ranging market condition such as this, what we're going to do now is that when price goes outside of it, we're going to do a trade that will make price come back inside of it. So for instance, we have this now, so we're going to say okay, we're going to do something like this, so that by the end, because we already know that prices are high, this is a high price now, so by the end of the expiration, we'll know that the price will be closing inside the Bollinger Band. So this is what we have as our Bollinger Band's trading strategy. This is how we can use price action and Bollinger Band to get our trade in the morning. So for instance, now if you're looking at this market, you can see that the price has already formed a resistance line. For those of you who do not have the ebook, I advise you get that ebook and take your trade seriously. Learn all you have to learn from it. You can see price has already formed a range inside, sorry, a resistance inside. Now this resistance level in confluence with this Bollinger Band that is flat like this, you see, flat like this. Okay, I'm going to tell you about the volatility as well. The Bollinger Band is flat like this. In confluence with it, you can see that the evidence that price will come back into the Bollinger Band is higher than the evidence that price will keep going up outside the Bollinger Band. Okay, so that is what we have now. For like you all know, when you trade with this Bollinger Band, it is not an 100% sure strategy. No strategy is 100% sure. So you have some winning trade, you have some losing trade, but at the end of the day, if you are using a good strategy, you find out that the winning trade will definitely be more than the losing trade, and this is how we end up being in profit. Now I haven't said that. Let's move on to volatility. Let's move on to volatility and liquidity. Now what I mean by volatility and liquidity is the size of the Bollinger Band. The size of the Bollinger Band, that means if you look at this, if you are going to look at this, what you find is that the size of the band between here and here, you see the space is high. Between here and here, the space is high. The space is wide, sorry. But if you look at this now, the space is tight, very tight. Now what does this mean? It means that with this market condition, it is safe to trade, because if you are entering your trade anywhere here, you find out that the candlestick will be going in your direction smoothly. You have enough space to get in the money. But this market condition tells you one thing, that volume is low, stay out of the market. But if you want to trade, you can trade at the edges, but don't trade inside because the volume is low. Forget about trading here, you are going to lose your money. So this is what it means. Okay, maybe this will be a trade that will be out of the money. Okay, it's out of the money, but at the end we all understand. Okay, we got that in the morning. So at the end we all understand what I was trying to say by using the Bollinger Band as an overbought and an oversold indicator. Now I've told you how you can use that for an overbought. If there is an opportunity, I should have showed you how you can use this for an oversold market condition. Now we can also use Bollinger Band to predict breakout, market breakout. How do we do that? We do that using the term called the Bollinger Squeeze and the Bollinger Bulge. Now I'm going to explain the Bollinger Squeeze and the Bollinger Bulge very quickly. Now the Bollinger Bulge happened when the market is in a trending market, and then all of a sudden it begins to lose momentum, and then it goes into a range. Now when this happens, we find out that the market is going to form support and resistance level within that range, and your trading strategy you have to switch your trading strategy to what the market is offering. So for instance, we have a bulge here because we can see this clearly. If you look at this place, we have a downtrend, price was moving inside, and then we have this bulge. You can see this. This is the bulge I'm talking about. This bulge happens when the price is moving inside back to the band, but the band is still coming downward. There is a deviation between the band and price. And what happened next, you find out that the market made what? A resistance level here. If you look at this, this is a resistance. I showed you how do you identify a resistance. You can do that by getting the ebook, and you'll see everything there, the psychology of the resistance, the action you need to take, and all of that. Now we have the resistance. Now having this resistance, we are now sure that we are in a ranging market, because this is one of the characteristics of a ranging market, is that support and resistance work in a ranging market more than a trending market. For trending market, you can use the change of polarity, you can rely on trend lines, but for ranging markets, support and resistances are the best. Now this is what the Bollinger Band tells us. We are going to, if there is a shift in market condition, switch your strategies, switch your analysis. Now this is what the Bollinger Bulge, and like I told you, this is the bulge, this is what it tells us. Now after the bulge, what happens? You find out that we have this ranging market. You see, the ranging market is characterized by flat Bollinger Band. Now after the Bollinger Bulge, there is one thing that happens for us to identify a breakout. We call it the Bollinger Squeeze. Now when the squeeze happens, it's like when you are putting pressure in something and then releasing it, inflating a balloon with air, and you're tightening the source of air. When you open it, everything comes out at once, and this is what the squeeze is all about. When the Bollinger Band squeezes together, just like we have here, you see after this bulge here, you see the squeeze coming in, the ranging market, and then this breakout. Once we see the breakout, we get the pullback. What we have next is a downtrend. It also happened here too. We see the bulge coming in, we saw the squeeze, you see the squeeze again coming in, and what happened? This breakout, and then we had this downtrend before we had a new bulge again. Let me see if I can get more other examples of bulge and squeezes. Okay, you see, we have this bulge here. This is a Bollinger Bulge here, and it happens both up and downtrend. So you can see the price was going inside, but the indicator was still coming downward. This is the beginning of, when you see this, okay, you have to tell yourself the market is about to range. Get ready for support and resistance trade. So now when you get this, what you find out is that support and resistance automatically forms. It forms. You see it, support and resistance happens. Then after that, you get this Bollinger squeeze. What I told you about the squeeze is a very tight and narrow space, lack of volatility. You see that the squeeze happened here. And after the squeeze, you see it here. See it coming. Everything is tight, and then boom, you have this breakout, a pullback, a breakout. And now for this, what kind of strategy you need at this level? You need the change of polarity. Yes, you need a change of polarity at this level, so that when you have something like this, when you have a low like this, you put your low here. You see that price came down, retested this low, doing a fake breakout with this candle, and continued going down, broke this next low. You see this price coming back, testing it, and price continued going down. And when price got to this place, what did we see? We saw price in an oversold market condition. And how did we confirm that this is an oversold market condition? Check your ebook. I told you about the piercing line pattern. With the piercing line pattern, we saw that this is an oversold market condition. This is a piercing line pattern here, and with this piercing line pattern, we can see that price went up for the next few minutes and then it continued. But in this case, it did not continue inside the one deviation. It has now gone to the middle Bollinger Band, and for that we can observe that the strength of this downtrend will not be as strong as it used to be, and so we switch on to what the use of trend line. We can now say, okay, we'll use the trend line. We're going to draw trend lines, and then we're going to use the information gotten by the trend line. As you can see, this is what we do. So we can be selling here, sell here, sell here, sell here. This is also like support and resistance, but in this case they work in a trending market. So this is what Bollinger Band is all about. There are also some uses. Now the market has broken out. So for instance, I told you about the one deviation and the two deviation. This is where the trend is strongest. At this point, the trend is really strong, so you can rely on only call trade at this point. So for you to use this to do your call trade, you have to just wait for price to come to these edges here. As you can see, these edges here, when price comes there, you do your call trade. So if there is an opportunity, all you have to do when price comes there, because you are not using price action, you are just using the information from this indicator, all you have to do is to wait. Price comes there, you go for 2 minutes and you go for your call trade, and you'll find out that at the end the price is going to go up. Now if you look at this Bollinger Band at this point, you can see that the bulge is kind of happening here, so therefore you have to be careful and watch this bulge. When you are doing this, you have to make sure that the bulge is not happening, because if for instance you are doing this and then this indicator here, the two deviation is not just like this but like this, yet the price is not following it, then you will find out that the market is in a reversal mode and is coming to a ranging mode. So in that case, this trend line that the one deviation and the two deviation has formed will no longer be effective. What will be effective is a support and resistance line, because the price will be moving from this trend channel to a support and a resistance channel. So this is what it means to use the Bollinger Band strategy. In our next video, I'll be talking about other indicators like the EMA, the volume bars, and how you can incorporate each and every one of them to form a whole trading system, because using just one, relying on just one without the information from the other one is kind of not complete. So you can use everything you've learned from these different strategies, price action, and market psychology. When you learn these things, you are going to be a pro in the market and you can make a living. Then you can make a living out of trading. So if this is your first time in my channel, we have 183 subscribers. I say a big thank you to every one of you who have helped us reach this far. So if this is your first time in this channel, please like this video, subscribe to this channel. If you have a comment, leave your comments in the comment section, so you can see how easily it is to make money using binary option, but only when you understand what you are doing. And by understanding this, I urge you all to get the ebook where everything is being explained, the price action, the psychology, and the setups. So until next time, take care and bye bye.